Hi, everyone, and welcome back. We're all swimming in this sea of information every day, right? It can be really hard to know what's actually important. That's why we do the deep dive. We try to be your shortcut to, well, getting it, to those insights. We sift through the research, the articles, our notes, and pull out the core stuff for you. Today, we're diving into something big, something that's really shaking up a whole industry, blockchain technology and its impact on accounting. And we're looking at it specifically around now, 2025, because our sources show this is really a key time for this transformation. It's happening now. So our mission today, to really unpack how blockchain is solving some age-old accounting problems. Things like data being messed with, fraud, just general inefficiency, and how it's bringing in this new era of transparency and automation. Okay, let's get into it.
It's a really good topic because, we're not just talking about tweaking the current systems. This is more fundamental. It's changing how financial systems even think about trust, about verifying things, about keeping records. It goes deep.
That sounds massive. So, okay, to get everyone on the same page, let's start with the basics. What is blockchain, fundamentally? We hear new kind of ledger thrown around, but what does that actually mean in simple terms?
Right. So at its heart, blockchain is a distributed digital ledger. Think of your standard accounting ledger, okay? But instead of one copy sitting on, say, one company server, you have identical copies spread across many, many computers, all linked together in a network. These computers are the nodes. Transactions get grouped into these blocks, and each new block is locked onto the previous one using cryptography, like a digital chain. The really key part, once data's in a block and the network agrees it's valid, you basically can't change it. Not without getting most of the network to agree, which is almost impossible. So it makes messing with the data, fraud, that kind of thing, incredibly difficult.
Wow. Okay, so it's not just a database, it's like a super secure, shared, almost unchangeable history book.
Yeah, that's powerful. And there's another piece often mentioned alongside it. Smart contracts, what are they? How do they fit in? Good question. Smart contracts are basically agreements written in code, and they live on the blockchain. Think of them as self-executing DAOs. If the contract says pay person B when event A happens, the code automatically makes that payment happen once event A is confirmed on the blockchain. They automate things like payments, checking if rules are followed, other financial steps. No middleman needed, no manual pushing of buttons.
Okay, so the rules are set, and the blockchain just executes them automatically when the conditions are met. Very efficient.
Exactly. And it builds trust because the rules are clear and the execution is tamper-proof.
Makes sense. So now we know the what. Let's talk about the why. Why bring blockchain into accounting? Accounting can be pretty traditional. Is this really solving a problem that old systems just couldn't handle?
Well, what's really interesting is how it tackles the weak spots in traditional systems. Those are usually centralized, right? One main database, one main server. That means one single point of failure. If that gets hacked or crashes, you're in trouble. Plus, it's easier to tamper with data in one central place. Blockchain, because it's distributed copies everywhere, gets rid of that single failure point. Much harder to attack. It also cuts down on manual errors because transactions get checked by lots of nodes. And crucially, everyone sees the same ledger in real time. So real-time reconciliation.
Right, and that real-time aspect, just imagine. You have suppliers, the company, maybe auditors or regulators, and they all see the same up-to-the-minute tamper-proof record simultaneously. Think about the trust that builds, the efficiency. No more chasing invoices, no more, well, my records say this. It's just there, verified.
Exactly. It eliminates so much friction and doubt in the process.
It really does sound like a completely different way of working. So let's dig into the specific upsides. Here's where it gets really interesting. What are the key benefits this integration brings to the table? We found about 6 main ones popping up consistently.
Yeah, and these aren't small tweaks. They really change the game. First up, transparency and auditability. Every single transaction leaves a permanent, time-stamped footprint on the blockchain. That gives you a complete, traceable history for audits. Audits become less about digging through old records and more about continuous, real-time checks.
Okay, so audits get faster, easier, and more reliable. What's next?
Second, automation. We touched on this with smart contracts. They handle routine stuff automatically. Think approving invoices, maybe running payroll, processing expenses. It just happens when the rules are met. This frees up accountants from doing repetitive data entry to focus on, well, more strategic work, analysis, planning.
Becoming more like financial advisors than just number crunchers.
Got it.
Third,
fraud reduction. This is a huge one. Because of the cryptography and the whole decentralized setup, changing records is extremely hard. You'd need to compromise a huge chunk of the network all at once, practically impossible. So it drastically cuts down the chances for fraud or even significant errors.
Okay, enhanced security and integrity makes sense. Number 4.
Fourth, real-time reconciliation. Transactions update for everyone involved instantly. This means fewer mismatches between what different parties think happened. It gets rid of that painful end-of-month rush to make different books agree. Accurate data, always available.
That sounds like a dream for many finance teams.
Okay, fifth benefit.
Fifth is regulatory compliance. Having those permanent, unchangeable records makes proving compliance much simpler. It streamlines reporting to regulators and meeting standards. It's sort of like compliance is baked into the system.
Proactive compliance rather than reactive checks. And the last one. And finally, number 6, identity verification. Blockchain systems can control exactly who is allowed to do what or see what, so you can ensure only authorized people access sensitive financial data or approve transactions. It secures digital identities within the system.
Okay, that's a really powerful list. Transparency, automation, less fraud, real-time reconciliation, easier compliance, and secure identities.
Yeah.
A strong case. Now, moving from the why to the how. How does a company actually implement this? It sounds complex. Our research pointed to a sort of structured 4-layer approach.
Yes, exactly. It's not like flipping a switch. You need structure. The source material laid out this helpful 4-layer framework. It shows how different parts of a business interact with the blockchain for accounting. So at the top, layer 1 is the decision-making layer. This is strategic, setting long-term goals, looking at big-picture economic data, using analytics for major financial planning.
High-level strategy stuff.
Okay. Then, layer 2 is the management layer. This is more tactical. It's where you find things like budgeting systems, tools managers use for day-to-day operational decisions, making sure things align with the strategy.
Okay, strategy flows down to management. What's next?
Layer 3 is the execution layer. This is where the actual business happens. Your operational units, sales, purchasing, logistics, whatever. They act like individual nodes on the network, recording their transactions directly onto the blockchain as they occur. Real-time data capture right at the source.
So the activity itself generates the record.
Right.
And the final layer.
And layer 4, the foundation, is the audit and control layer. This layer provides that continuous automated auditing and oversight. It's constantly checking transactions against rules, ensuring compliance, offering transparency, all in real time, no waiting for quarter end. And crucially, smart contracts kind of weave through these layers. They connect them, making sure interactions are validated, efficient, and follow the rules across the whole structure.
That framework really helps clarify how it could integrate across an organization. But theory is one thing. Let's make it concrete. What does this look like in the real world? We saw a great example, a big multinational retailer using blockchain for its global supply chain accounting. Can you walk us through that?
Right. So picture this huge company, suppliers all over the world. Normally, everyone keeps their own separate records, leading to mismatches and delays. With blockchain, every step placing an order, the shipment leaving, the goods arriving, the payment is logged as a separate transaction on a shared ledger that both the retailer and supplier can see.
Exactly. And the smart contract is key here. Let's say the retailer's warehouse system logs goods received onto the blockchain. That confirmation automatically triggers the smart contract, and boom, the contract executes the payment directly to the supplier's account.
Wow. So no more waiting for invoices to be processed manually, chasing payments?
Precisely. It cuts out delays, reduces errors, improves cash flow for the supplier, and simplifies reconciliation for the retailer. And the bigger picture. All the stakeholders, auditors checking things, managers overseeing the supply chain, even regulators potentially. They all have access to this live, verified data. That creates incredible oversight and trust in a really complex global operation.
Absolutely. It transforms the visibility and reliability of the entire process. But this does raise an important point. If it's so good, why hasn't everyone jumped on board already? What's holding companies back? What are the hurdles?
Yeah, there are definitely real challenges. First off, costs. Setting up these systems isn't cheap. You need the tech, but also significant investment in training your people. It's a big initial outlay.
Okay, cost is always a factor. What else?
Then there's regulatory uncertainty. The rules and accounting standards around blockchain are still catching up. For businesses, that lack of clear guidance can make them hesitant to invest heavily in something where the legal landscape might shift.
Right, nobody wants to invest millions in something that regulations might change later. Makes sense. Another big one is scalability and integration. Many companies have existing, often older accounting systems, legacy systems. Getting these old systems to talk smoothly to a new blockchain network can be technically very difficult and time-consuming.
So the technical integration challenge and the last barrier.
And finally, just plain old change resistance. People and organizations get used to doing things a certain way. Moving to blockchain isn't just a tech upgrade, it's a process change, a cultural shift. You need to get buy-in, manage that change, and train people extensively. That's often underestimated.
Those are definitely significant hurdles. Cost, regulation, technical complexity, and human resistance. You can see why adoption takes time. However, despite those challenges, the overall feeling from our research is still quite optimistic, isn't it? It seems like as people get more aware, as the tech matures, and hopefully as regulations become clearer, blockchain really is poised to become a central part of accounting. The momentum seems undeniable.
I'd agree. The fundamental benefits are just too strong to ignore long term.
So wrapping things up from our deep dive today, the big takeaway seems to be that blockchain isn't just another tech trend for accounting. It really represents one of the most fundamental shifts in the field since, well, maybe since computers first came into bookkeeping. It rethinks the core principles.
Absolutely. Its promise of transparency, security, automation, and continuous auditability makes it an incredibly powerful tool. It's moving beyond the hype now and becoming a serious consideration for accountants, auditors, and business leaders looking for better efficiency and integrity.
Definitely. And maybe a final thought for you listening. Whether you're studying accounting, teaching it, or working in the field every day, now really is the time to get familiar with blockchain applications. Understanding this transformation isn't just helpful, it's becoming essential to stay ahead. The landscape is changing fast. Thank you so much for joining us for this deep dive. Keep asking questions, keep exploring, and we'll catch you on the next one.